Welcome back. Today we do a practical exercise for fundamental finance mastery. That is the ending of the series you'll do in the fundamental finance mastery. Now let's take a look at an exercise about the time value of money, TVM. Our goal is to evaluating an equipment purchase. This is the scenario. A company invests $50,000 today in a new software. It generates $18,000 annually for 3 years. The discount rate is 8%. What we do know. How to apply the TVM formula for evaluate our equipment purchase. Someone know what is the formula? If you know, write in the comment. Let's do this. This is the math calculation to charge the present value of your equipment purchase. The formula is our TVM equal the amount generated divided by 1 plus rate power n. N is the years. We do a calculation. If you see in the slide, on the first years, we have $16,000. In the second years, we have $15,000, and in the third years, we have $14,000. So we make a simple calculation. The present value PV of our equipment is $46,000. What is the decision we could take about it? The investment, the present value, is lower than the cost of your equipment investment. What is the solution we must take? We must reject the project because if we persist to do the project, that can create a loss for our company. Okay, this is a simple graph showing uh, our investments. Let's pass it. Now, how to calculate a budgeting and how to take a decision on it. NPV, net present value versus payback periods. This is another scenario. The project X costs $100,000. The cash flow in the first year is $60,000. In the second year, $50,000. And the third year is $20,000. Cost of capital is 10%. The payback period is 1.8 years. We recover $100,000 during years 2. What is our net present value? This is the formula. And after calculation, we had $10,000. What is the decision we could take? We must accept the project because the net present value is positive. This is the graph showing the versus of initial investment and the cumulative discount cash flow. We see the green bar is higher than the red bar. Understanding the income statements. Exercise. Profitability margin analysis. This is a few data. We had a revenue $1 million and a COGS $600,000. Operating expense $250,000 and the net income $120,000. How is your gross profit margin? After calculation, we get 40% of GPM. How is the operating profit margin? EBIT. After calculation, we get 15%. And how is the net profit margin? After calculation, we get 12%. This is the graph. Income statement breakdown. Revenue to net income. Working with a capital management. Exercise. Optimizing the cash conversion cycle. If you're thinking what we must do in the CCC. In the CCC, we must know how could I invest fewer but get higher and use M&A in a long cycle investment. This is the formula. CCC equal die investor outstanding DIO plus die sales outstanding DSO minus die payable outstanding DPO. Company metrics DIO 45 day, DSO 30 day and DPO 35 day. After calculation we get 40 day for our metrics. What is the target goal? Target goal is to reduce the DIO and the DSO while safely increase DPO to free up trapped cash. Let's see a graph to show how is it work. 45 die DIO, 30 die DSO, and 35 die for DPO. This is a sample graph show you how is the linear cash conversion cycle CCC work. In the input you make your cash and the output you recover your cash. But inside you must make an investor acquisition, you must have a time to sell investor, you must have a sales of good, and you must have a time to collect receivability. Financial leverage risk. Debt versus equity financing. Scenario. Expansion require $200,000. Option A. 100% equity. Option B. 50% debt at 6% interest. 50% equity. Expect a BIT $40,000. Option A. All equity. Return on equity ROE. If you calculate, you have 20%. And the option B, the interest is $6,000. The earning is $34,000. The ROE is $34,000 by $100,000. That means you have 34%. The risk warming. The leverage amplify return but increase financial distress risk if EBIT falls. Let's see the cost of a capital. To calculate WACC. What is WACC? Chart and you write in the comments to share it with our colleagues. Company data, market value of equity $60 million. Cost of equity 12%. Market value of debt $40 million and cost of debt is 6%. Corporate tax rate 25%. Total value is 100 millions. After calculation, we had 9% of WACC. This is a sample graph showing you the difference in the one hand equity component and in the other hand the debt component. You see the blue is represent your equity and The green is represent the depth. Breaking-even analysis. Finding the safety margin. Our exercise is here to chart in what value I have the safety margin. This is the company data. Fixed costs 80,000 in a year. Selling price unit $50 and variable cost per unit is $30. You see the difference of selling price and the variable cost is $20 per unit. Break-even point units, fixed cost by contribution margin. So we had 400 units. Break-even point sales, we had $200,000. Let's see a graph. The red and the green. In the axis, you see units sold, and in the Y, in the Y axis, you see the amounts. Green is total revenue, and total cost is red. Fixed cost is a dot. Break-even point is a black dot. Loss zone and profit zone. You see, if you have a higher unit to sold, you had a great interest in your revenue. But if you had a lower unit to sold, you have a higher cost. That means you have a deficit in your sold. Valuation basics. Exercise dividend discount model DDM. Scenario. Stock pay an annual dividend $2.50 next year. The dividend grow at a constant rate of 4% indefinitely. Required return is 9%. Formula to calculate the Gordon graph. The Gordon graph is our last lessons. After calculation, we had $50. Market decisions. If the current stock market price is $42, the stock is undervalued. We must buy because the Gordon graph indicates $50 is the average of the price. But if we had a $42, we must buy because we gain a $8 difference between the average value and the real value. This is some graph to show you how to take a margin of security or a margin of safety area in your investments. And let's conclude with a key takeaway for making sound financial decisions. First, cash is king. Profitability on paper does not equal cash liquidity in the bank. Second, time alters values. A dollar today carries more utility than a dollar tomorrow. For five, risk demand return. Never assume higher debts or risk without a calculated premium. Thinking about take a debt before doing action, because if you take a higher debt and you don't know how to pay it with the rates, you have a great risk in your investment. The data-driven focus. Use NPV and WACC consistently to eliminate emotional bias. I think that is for this chapter, guys. Thank you very much and see you soon in the next chapters.